Hi guys, welcome to a simpler approach. If you are new to the channel, please, I ask that you subscribe, like, comment, and share. Now I do apologize for the absence of my usual introduction. Unfortunately, the device that I was using to record the introduction developed some technical difficulties. And as such, I will be using this means for now, for the entire video, that is. For those who are watching this video as the first video on my channel, I will leave in the description below the link to my introductory video that will explain who I am, what this channel is about, and you will see my face. Today, we will be looking at the accounting system. We're going to dive right into it. There are guidelines and procedures that exist with the sole purpose of guiding the process of accounting, just to ensure that the process is fair and universal. And we will be going through some of these guidelines, otherwise called concepts and conventions. The first one being the business entity concept. And this concept simply states that the business and its owner are legally two separate parties, two separate people. So if there is an issue with a business and someone decides to sue, they would not be suing the owner, they would be suing the business. Why? Because legally, the owner and the business are two separate persons. Number two, the dual aspect concept. This concept states that there are two aspects of accounting. On one side, you have the assets that are owned by an entity. And on the other side, you have claims against those assets. That statement is justified by assets equal capital plus liability. The assets that are owned by the entity and claims against those assets, which would be capital and liability. In a video to come called Double Entry, we will be diving deeper into this concept and bring out what are assets, various types of assets, what is capital, what is liability. So stay tuned for that. But for now, dual aspect concept, two sides of accounting, two aspects, one represented by the assets of an entity and the other represented by claims against those assets. Number three, the historical cost concept. And this concept states that all assets that are owned by the entity must be shown at their cost price, which is used as the basis for valuing them. And cost price represents the price at which the asset was bought. Number four, the money measurement concept. And this one is simple. If it cannot be measured in monetary terms, accounting cannot speak to it. Accounting deals with money, monetary value. If there is no monetary value on it, accounting cannot deal with it, cannot speak about it or to it. Number five, the going concern. This concept simply states that a business will continue to operate into the foreseeable future. This might not be the case, but once a business is established, the going concern automatically says this business is going to continue into the foreseeable future. The consistency concept, number six. And by the word consistency, we get an idea of what this concept is all about. All the applications of accounting that a firm is using, the principles, the methods, the practices, the procedures, They must be the same from one accounting period to the next. And an accounting period is usually a year. So you cannot use one method in year 1 and then switch to another method in year 2. No. That's not how it works. There must be consistency. Now, if there is going to be a change, the change must be mentioned and that change must continue over a prolonged period of time, thereby coming back to the root of the concept, which is grounded in consistency. Number 7, the prudence concern, also known as conservatism. This concern states that revenues, expenses, assets, liabilities, or any other item within the accounting process shall not be overstated. Now, the word overstated simply means that you are recording the value more than what it's supposed to be. So if revenues is estimated or calculated at 1 million, you are supposed to record 1 million. Don't record 1.4 million. That would be overstating what it actually is. Every record must be fair, accurate. Cool. Number 8, the realization concept. This concept says that revenue or expenses are recorded when they occur, or in other words, when they happen, rather than when they are paid or received. This means that when you go down to Marstam shop, or for my international students, when you go to the supermarket and you purchase an item, realization dictates that revenue/expense takes precedence or occurs or happens when the transaction takes place. Not when you paid for it or not when you received it, because there are instances where items are bought on credit. So you don't record revenue when the money finally comes. It is recorded when the transaction takes place. Linked to the realization concept is the accruals concept. And the accruals concept says that revenue and expenses are earned whether or not they have been paid. Let me say that again. The accruals concept states that revenue and expenses are earned or conceived whether or not they have been paid. So the realization concept says when the transaction takes place, that's when it's recorded. You don't do the recording when the funds are received. The recording is done when the transaction takes place. Therefore, accruals is saying the revenue has been earned, the expense has been conceived, whether or not you paid for it. I know that's going to blow some people's mind, but in a topic to come, we will dive a little deeper into that one. Accruals, what it is, and how it's set up. So don't worry about it. Number 10, separate determination. This one is very, very, very simple. Every asset and every liability must be determined separately. In other words, treat them by themselves. Good. Number 11, substance over form. This one is saying, my international students, this is what's happening. The economic substance of a transaction or its event must be recorded in the financial statement rather than just their legal form to present a true and fair value of the affairs of the entity. Now, I read that one out for a reason. Watch this. Every single transaction and event that takes place in the entity must be placed in their financial statement. It doesn't matter what their legal form is. It doesn't matter how else or where else you want to write them or place them. Once it has economic substance, it must be placed in the financial statements. As in where in the financial statement it's supposed to be, that's where it ought to be. Why? Because recording this economic substance will require true and fair representation on the books of the entity. Now, if this item is not recorded properly, it runs the risk of presenting a false view or a false financial position of the entity. And to eradicate that or to limit the possibility of that, all economic substance, transactions of economic substance, must be recorded in the financial statements rather than just their bare legal form. And the number 12 and last, the materiality convention or concept. Now this one states that items that are of a significant value and those that are not must be distinguished one from the other according to the accounting statements. So if one transaction has significant value and the other doesn't, differentiate them, record them properly, record them accordingly so that they will be able to reflect accordingly. The entire accounting process is summarized right here. The accounting cycle. Number 1, you have source documents. Number 2, you have the journals. Number 3, the ledger or T accounts. Number 4, the trial balance. And number 5, financial statements. We're going to look at each of these in a more detailed way. Number 1, source documents. Source documents are the first piece of evidence that proves that a transaction took place. When you go to the supermarket to purchase grocery items, the first piece of evidence that you receive that proves that you bought your grocery is your receipt. Likewise, in the process of accounting, various source documents include invoices, sales and purchase invoices, debit and credit notes, petty cash vouchers, bank slips, paying or payout slips, receipts for cash paid or cash received, or any other hard evidence that proves that a transaction took place between two parties. Number 2, journals. All transactions are classified and then placed into a respective journal. There are 7 journals or books of original entry. You have the purchase journal, the sales journal, the returns inwards journal, the returns outwards journal, the cash book, the general journal, and the petty cash book. All these journals we will be looking at very, very, very soon. Number 3, the ledger. This is a place where all T accounts are kept. Now there are 4 ledgers. You have the sales ledger, the purchases ledger, the general ledger, and the cash book. Now, we will understand this in greater detail, but in order for you to understand what this is saying to the best of your ability, let me provide a little basis upon which you will be able to better understand. Now, T accounts are literally capital T's, where information is recorded in. On the left side is called the debit side. On the right side is called the credit side. Every information relating to an asset, liability, capital, etc. is placed in that T account. Now, for classification purposes and to avoid chaos and confusion, there are 4 ledgers that dictates how these T accounts are classified. Now, the sales ledger has the accounts of all the persons that we sell goods on credit to, otherwise called our debtors or our customers. So it has a T account of all our customers. The purchases ledger contains the T account of the persons that we buy goods on credit from, our creditors or our suppliers. The general ledger has all other accounts except the cash account and the bank account. And the cash book contains the cash account and the bank account. And note, a few minutes ago, we looked at journals and we recognized that the cash book is a journal. And here we are seeing that the cash book is also a ledger. Now remember this, the cash book is the only journal that is also a journal and a ledger. Why? It is a ledger because 2 T accounts are placed in it, the cash account and the bank account. In addition to what was explained about T accounts just now, also note that T accounts are classified in 2 categories. They are either personal accounts or impersonal accounts. Personal, as the term personal would suggest, are accounts that belong to people or businesses or debtors and our creditors, to be exact. Impersonal accounts are further broken down into you have real and you have nominal. Real accounts are those accounts that deal with possessions, such as land, building, machinery, stationery, possessions that the business have. Nominal accounts are those accounts that have to do with expenses and income. Number 4, the trial balance. The trial balance is simply a statement that tests the accuracy of double entry. We'll talk about that in greater detail, for sure. And number 5, financial statements. Financial statements are statements that records a business's activities and it depicts an entity's financial performance over a period of time. And as I said before, that period of time is usually 1 year. Accounting period, which is usually 1 year. Now there are 2 main financial statements. There are more, but right now, at this stage, there are 2 main ones. The income statement and the statement of financial position. Now the income statement, otherwise known as the trading profit and loss account, that's the old name, new name is the income statement. This statement shows a business's gross profits and net profits for a period. And the statement of financial position, also known as the balance sheet is the old name. This statement shows an entity's financial position. It shows all their assets, all their liabilities, and when they are compared one with another, it depicts the entity's financial position. Types of business organizations. Now, every single business falls in a specific category, in a specific type. And we're just going to look at the 5 main types right now. First one, the simplest one to understand, the sole trader. Now, this is a business entity that is owned and operated by one individual. Advantages: all the profits made belongs to this individual. But the major disadvantage is that they are liable for all the debts that the business incurs. Number 2, partnership. This is a business venture that is owned and operated by a minimum of 2 persons, maximum of 20. Advantages, responsibilities, capital is shared. Disadvantage, profits and losses are also shared. Limited liability companies. These are entities that are owned by shareholders. Now, a shareholder is an individual who holds shares in a company. Shares is a single unit of ownership in an entity. And to acquire that unit of ownership, you must pay for it. Okay? Major advantage to limited liability companies, you only lose what you invest. If you invest $500,000, that's what you will lose. You will not lose your personal assets, your house, your car. No, none of that will take place. Only what you have invested, you will lose. The major disadvantage, though, is that where shareholders are concerned, you find that profits are shared, yes, but profits are shared to a greater degree. So multiple shareholders means sharing of profits in multiple ways. Non-profit organizations. Now, these organizations don't necessarily exist for primarily profit-making purposes. Their primary focus is to provide a necessary service to their members. Now, their funds comes from subscription fees paid by members and donations that are grants that are given to them. And finally, cooperative societies are legal entities that are founded on the basis of providing economic welfare to their members. And they do that by providing an atmosphere of service for goods and services to their members at cheaper rates. So you find, for example, a set of individuals coming together and they provide the goods or service for their members at cheaper rates. Computers. Since the invention of computers, our lives have been so much easier. In some ways, it's made us lazy. But in other ways, it's made us productive, you know. It has helped us to accomplish tasks a lot easier and a lot quicker. And in the field of accounting, it's the very same thing. With software such as Peachtree, QuickBooks, Sage, we find that the process of accounting, bookkeeping, payroll, inventory control, or even accounts, receivables, and payables, that entire process has gotten a whole lot easier. We find that there are faster processing speeds for transactions and recordings, and when you're using a computer, naturally, you will find greater speed compared to if the process was being done in a manual way. You find also that access to the information is easy. You can just save it on a computer hard drive. You can save it on a server. You can save it on an external hard drive. And that would allow you to retrieve the information as quick as possible and easy as possible. Disadvantages to computerized accounting in this case includes the cost of setting up the software and the computer system that you would need to run the software, and that can be expensive. Also, it makes no sense to have the software and the system, but the persons using the software don't know how to use it. Therefore, you have to train the users of the software so that the results they get will be accurate and efficient. This takes us to the end of our lesson for today. Now, I really hope that the information was clear, precise, to the point. I hope that you learned something. And if you enjoyed this video, please subscribe, click that notification bell so that whenever I upload videos, you will be the first to know. Additionally, remember, if you have any concerns or comments, you want to ask a question perhaps, feel free to do so in the comments section below and I will respond to you directly. Okay? Thanks for watching. Thanks for staying tuned. Stay safe. Walk good.